equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are talking about an asset class that I believe you've had some interest in before.
Yes.
But it's becoming more and more accessible for retail investors. So I'm excited to get into it.
Yes, it is carbon credits, Ren, and we've got an expert in the studio. So we would love to welcome John Caulfield. John, welcome.
Thanks very much. Good to be back.
So John is Director for Institutions and Intermediaries at ETF provider VanEck Australia. And before we get into it, just a reminder that we are licensed. However, we are not aware of your personal circumstances. All information on this show is for education and entertainment purposes. Any advice is general advice only. But John, as Ren said at the top, an asset class that is getting more accessible, which is carbon credits. And VanEck have just launched Australia's first carbon credits ETF. The ASX ticker is XCO2. So
Absolutely.
Explain it like I'm five.
Yeah.
What is a carbon credit?
Yeah, well, I mean, think of a carbon credit as basically a permission slip to emit. So essentially,
Nice.
there are emissions that, come out of industry, aviation, obviously just general power generation. The aim, as we know, with sort of climate awareness, climate change, ESG, is to try and limit global warming, and reducing emissions is the way to go. So, this is a structure that's been put in place to basically, monitor those emissions. And, certain industries will have a limit of what they can emit over a certain year. And we can get into the sort of mechanics of how these things come into existence and get used. But it's essentially saying to, an energy generator, you now have permission to emit 1 ton of CO2.
And so I take it if I invest in your ETF, I'll have permission to emit more carbon.
I mean, look, the ETF itself is basically an exposure to, call it an asset class or a commodity, which is the price of carbon. So like I say, we can sort of talk about how the ETF and what we hold translates through to the actual credits. But, think of it as you are helping that price discovery process. Yeah.
Well, before we do, let's just talk about carbon credits in general, and then we'll get into the investing side of it. So it's a permission slip to emit.
Yep.
How does a carbon credit scheme or an emissions trading scheme actually reduce the total amount of emissions?
In terms of changing behavior, and that's what this is all about, we're trying to change the behavior of people, but industry as well, to reduce, carbon emissions. And economists generally agree that the best way to do that is to put a price on carbon. And so, carbon credits essentially involve the regulated markets. So where there's sort of mandatory caps on emissions, and those credits get issued or need to be bought and sold, traded, reasonably similar to carbon offsets. And the term gets used interchangeably a little bit, but the offsets are, I guess, more relevant to the voluntary market. So, you don't necessarily have to go and do something, but where you book your Qantas ticket and they say, do you want to offset something? And you tick the box. You're not mandated to do that. So that's just the offset. Someone's going to go and plant a tree, but the credits themselves, like I say, it's, legislated.
And a lot of the companies that are saying they're going to be net zero by a certain date, they're buying offsets.
Correct.
Government aren't telling them they have to be net zero, but they're doing it. Yeah.
Well, again, in Australia, we have this voluntary market where, people are offsetting their actions. And like I say, that's best endeavours. It's not the government sort of holding them to account. Whereas in other markets, which are more developed, and I mean, we'll talk a bit more about Europe, which, certainly are the leader in this space, it's written in law. And that's where the credits come into it. And, those will get issued and they need to be used, as you say, by companies to, either hit their targets or pay up if they don't.
Let's move to how they are investable as an asset class, because that's kind of why we're here today. You've just explained how they work for companies, allows them to sort of offset their carbon emissions, but how are they actually an investable asset class?
Yeah. So, I mean, these credits are issued by governments and regulators. Some of them are given away to companies to help with that transition. Others are auctioned by governments. And so, again, companies need to go and bid up and pay. And then you do get, obviously, industries who, you may have a rainforest or a carbon capture firm. You essentially get those credits that you can put into the market and sell to those that need them. So, there are these exchanges where you can sort of buy and sell. It's not that easy for sort of retail investors to go and buy credits, but it's certainly possible. And it's, obviously more an industry-led activity where people are buying and selling these things for genuine, like I say, legislated reasons.
Like conceptually, an emissions trading scheme will make sense to people when it's companies and governments, and it's, the government looks at how many emissions are in the market in 2022 and says, you guys will all be given credits or permission slips at 10% less than your emissions from this year. And then you guys need to trade amongst yourselves, but we're capping the amount of emissions and then we're trading. Like that makes sense. And then all of a sudden you put investors in the mix and they also have the ability to buy credits. And it becomes a little bit more confusing, I guess, in terms of what role the investor plays and how that changes the market. So how do they change the market? Does it push the price up? Does it push the price down? Net positive, net negative? I'd be surprised if you said net negative, given you've got an ETF. But how you throw investor into that picture, how does it change what comes out?
I mean, look, you're adding liquidity. And with anything, the more liquidity you have, the better your price discovery is. I think it's also important to say that, the European scheme was designed with investors/speculators in mind. Okay. It wasn't set up hoping that people would never participate in that role. So they basically saying, look, we know people are going to do this. And I mean, even the investor speculator side of it could be firms that actually do need these credits for legitimate reasons, but they are saying, okay, well, we're going to hold these credits on our balance sheet because we may need them next year or the year after. And we know that the price of carbon is going to go up, so we want to participate in that. And that's a natural hedge to things that may be going on elsewhere in our business as well. So I think the entire ecosystem is important, and it's, like I say, the more players you have, the more transparency there is, the more liquidity, the better the price discovery. And again, ultimately, we need people to change behavior, and they're only going to do that when the price of carbon is such that they are forced to.
With most asset classes, within that there are good quality assets and then not so good quality ones. Does that apply to carbon credits? Are there credits that some investors are really gunning for and others that you don't want to get your hands on as much? Yeah,
look, there is a difference, but I think, broadly speaking, the distinction could probably be split along the mandatory and the voluntary side of things. So like I said, where there's voluntary and you sort of say, well, look, I'm going to go out and plant a few trees if you tick the Qantas bucket. Having line of sight to, how big are your trees, how many have you planted, is difficult. And those are sort of, I guess, project specific. Whereas, something like the credits, what you're really doing is saying, well, for those credits to be put into the system as tradable sort of securities, for want of a better word, they do need to essentially be stamped by some sort of a oversight regulator. So you have that degree of certainty that what you're buying or selling is legitimate. And then, the price of carbon is ultimately what you're buying or selling there. You're not necessarily saying, I just own a patch of grass which has a few trees on it and that's my offset. Yeah. So it's very hard to quantify when it's project specific. Not impossible, and certainly there's some very good legitimate operators there, but like I say, it's just a bit more opaque.
Yeah.
Yeah.
So there are 25 emissions trading schemes around the world, and this ETF has exposure to 4 of them.
Yep.
I guess maybe introduce us to the 4 emissions trading schemes, and then we'll get into why those 4 and not the other 21. But to start with, what are the 4 emissions trading schemes that are in the ETF?
Yeah, so the 4 are Europe, UK, which used to be a part of Europe, but obviously spun out with Brexit a couple of years ago. And then we've got an East Coast and a West Coast US. So there's the California system on the West, and then East Coast is the regional greenhouse emissions, RGGI, REGIs, they call it. So those are the four. I mean, essentially the index that we track, as with all of these indices, have eligibility criteria. It needs to be, a mandatory system. It needs to be large enough. You need to have foreign participation, and there needs to be a futures market behind it, providing, again, that liquidity and price discovery. So those are the four at the moment because they're the largest and most developed. I think as we move forward, like you say, there are others that will become eligible, and we'll see, more of those ETSs included in the index at some point.
I didn't realize that the US was split California specific and then, what is it, Northeast USA?
Yeah.
Interesting.
Yeah. So again, I mean, it's, I think, 12 states on the East Coast. And then California actually includes Quebec as well. So,
Oh, really?
Yeah. Obviously, Europe is very much, call it government-led, federal, if you like, from a US perspective, whereas on the US side, it's all sort of state-led as well. So, all of these systems, will be set up differently, have different kind of aims, different caps, different targets, and will evolve.
We were going to talk about potential risks a little bit later, but I think this one becomes quite relevant now. So we have a system where the states in the US are taking action on their own, California notably, well out in front with carbon trading, also electric vehicles and stuff like that.
Yeah.
And there's always an open question of regulatory change when it comes to an asset class like this, where it's so driven by government policy.
Yeah.
Let's say, based on the midterms we saw last week, it doesn't look quite likely, but let's say 2024, the Democrats, sweep the House, they get more than 60 senators and they win the presidency, and the new Democratic president decides we're going to have a national carbon trading scheme.
Yeah.
How does that, is there regulatory risk for these state-based schemes? How does that change, the asset class or the assets that you've invested in?
Yeah, like I said, I think these things all will evolve. They've all been around for a while as well. The East Coast system's been up and running since about 2009. California 2012, I think. So we've already sort of seen, them exist, whether it's Democrats, whether it's Republicans. Again, I mean, you will see different states added to some of those systems potentially. Maybe the two of them get together at some point and say, we're going to, call ourselves something else, and everyone who is part of ours becomes one. Again, you wouldn't sort of put anything off the table, but ultimately, the industries that are involved, the emissions targets, the caps, how that's sort of worked out, I think, could be sort of standardized, normalized, whether it's state, whether it's federal, like I say, regardless of government.
So with the mechanics of the ETF, John, is it invested in carbon credits or is it the futures approach? Because I'm in one that's listed over in the States, which I think is the futures approach as well.
Yep.
What's the mechanics of it?
It is the futures approach. So like I said, I mean, it's certainly possible to get hold of credits directly, but they, don't trade as regularly or as, or in enough volume, shall we say, for something like an ETF to hold. So, you need the daily liquidity. The futures are the way to go in terms of an investment sort of product. And, correlation-wise, it's 0.0999 in terms of futures versus spot, if you like. So the futures market in carbon, or the price of carbon, actually tracks the spot price closer than we see in something like oil, for example.
We mentioned there are 25 emissions trading schemes. This ETF really looks at 4 of them, but there are some other ones around the world. New Zealand is one that's pretty close to home.
Yep.
Is that going to be included in the index in the future, do you think?
Oh, look, it's certainly on the radar. That question has come up quite a bit in our conversations with clients. Like I say, it is a mandatory system. It's just not quite large enough at the moment and doesn't have the futures market. So I think in terms of market size, we understand it's about half the size of California.
Yeah, well, maybe if Australia got their act together and we had an oceanic ETS. Yeah.
There we go. So, nothing's outside of the realms of possibility. We've obviously got our voluntary market here. And again, that's a question that comes up a lot, as is China. China has the mandatory system. It has been around for a while. It is quite an aggressive sort of target in terms of their caps, but there's no foreign participation at the moment. So again, they fall a little bit short in terms of that index eligibility.
So my thesis when I got into this was that there weren't enough credits to meet supply. Sort of has played out. There's been a few ups and downs over the last year or so. I think it's also had exposure primarily to Europe and whatnot. Is there a point that might tip in the opposite direction? We're seeing COP27 at the moment and a lot going on in this space. So what does the future hold for this if someone's kind of sitting at home thinking that the future of carbon credits is just going to get cheaper and cheaper?
Yeah, you're right. I mean, look, these systems have been around for a while. There have been some ups and downs. As with all of these initial designs, we do expect them to evolve, and they have evolved. And the supply-demand dynamic is certainly something that's been tweaked. And I mean, I'll talk to sort of the European experience, given it makes up around half of the index or the ETF, and like I say, is the most developed, both in terms of trading volume. Supply, we also think, is going to be the biggest driver of the asset class. And I think it was 2019 or so, they brought in a mechanism to say, okay, well, how many credits are there outstanding, on balance sheets or, in circulation? And if that number exceeds a certain number, and again, I'm not going to sort of go into the weeds of what the tons are, but 833 is the magic number. And we've got about, 1,500 in circulation at the moment. So they say, well, because we're above that 833, all of those new credits we were going to issue via auction next year, we're going to reduce that by 25%. And if we're still above the 833, the year after that, we're going to reduce by another 25%. So there's this mechanism in place for them to really keep supply under control. And obviously that is beneficial for the price of carbon, because ideally, they have targets. Like I said, it's written in blood. Whether it's Fit for 55, whatever sort of other European legislation is in place, these governments and industries and therefore companies are mandated to hit these targets. And if they don't have the credits, not only do they have to stump up any shortfall of credits that they missed this year in next year's allocation. So it's not like you just wipe the slate clean. You've got to actually pay up for any sort of deficit that you've had in a sort of existing year. But you also get penalized to the tune of around €111 per tonne for a credit that you haven't submitted, if you like. So, these guys, have to go out and source these things. If there are too many in circulation, like I say, there's this mechanism to reduce new issuance. And don't forget that governments are starting to earn, serious revenue from these credits as well now. They do need to reinvest some of that money into sort of clean energy and those sort of projects. Not all of it. So some of it, they can obviously just put in the back pocket, but a lot of it's got to be reinvested. And this is going to be a very strong, regular sort of revenue source for governments. So they have no incentive to see the carbon price lower, whether it's from a revenue perspective or whether it's from an emissions change of behavior perspective. So they're going to keep that supply-demand dynamic finely balanced in their favor.
With a lot of sort of commodity-based ETFs, the way that, they're used in portfolios is often not that sort of core, buy and hold for 25 years. It's to kind of just get exposure to the price when it's right in the sort of cyclical sort of process.
Yeah.
How are you advising clients to think about this in a portfolio? Is it a long-term growth play, or is this something that you do kind of think coming in and out of as the market dynamics change?
It is interesting. I mean, understanding how people see this from the initial discussion, and then, once you've had the discussion, how they see it maybe being used has certainly evolved. First cab off the rank, people go, well, look, if I'm environmentally or ESG conscious, this is for me. And then you sort of think, okay, well, it firmly sits in the alternatives bucket. Like you say, it is a commodity. It is not correlated very highly too much, about 0.3 to global equities and sort of single digits, teens to Aussie equities and bonds. So as a genuine portfolio diversifier, it can add value. So you don't need to care about global warming, the price of carbon. You just want something that's going to behave differently. And given the year we've had, when everything's down and everything's kind of correlated to one, carbon credits have been up. And like I say, that diversifier effect has been valuable.
Yeah.
You've also then got people who may not care about global warming or the price of carbon, and they just think, carbon today is X. By 2035, I see it going up to, 2X, 3X, whatever it may be. I'm just going to play that asset price, hopefully, rise. And then you've got clients that maybe are ESG aware and they don't own oil and gas anywhere in their portfolio for those reasons, whereas something like this is correlated to oil and gas. So you're kind of owning something that will help your portfolio keep up. Like I say, over the course of this year where, people who've been underweight energy have been hurt, this is a way of sort of negating that risk. And then again, you've got others who say, okay, well, look, I just own equities. Some of those equities going forward are going to really be hurt by an increasing price of carbon. And whether that's utilities, whether that's industrials, whether that's transport companies or all the way down the food chain, supply chain, this is a way for me to hedge that risk of an increasing price in carbon. So I think the way it can be used and the duration of its sort of use in a portfolio can honestly be, quite variable.
You mentioned there that governments have an incentive to make sure that the supply of credits isn't so high that the price falls. And we saw in Europe in the mid-2010s, I think the European system crashed in 2013 and the price was pretty low for a while and it's come back since. But there is an argument that governments also have an incentive to not keep the price too high because they don't want to cripple industries. They want to create enough incentive to transition without handicapping them against other countries that maybe aren't charging as much or don't have a system at all.
Yeah.
So really it should trade within a range, you would expect. Is that a fair assessment?
Yeah, look, I think so. Again, there's no single price on carbon, which again also complicates things. And again, to go back to the European example, I spoke about that 833 number where you start seeing supply reduced. There's a floor, if you like, of 400. So if the credits in circulation drop below that, they will issue an extra 100 odd tons of credits into the market the next year. So you're right. In terms of that supply, there will be a band. In terms of, the price of carbon and the index we track and the ETF, you've obviously got Europe as half of the weight, so their influence is large. What happens in the UK, the price of carbon in California is $13. The price of carbon in Europe's €88. So again, you've got disparity there, and like you say, if New Zealand comes in, what's the price? How much does the price go up? So again, you're sort of buying the price of carbon, but it's not a singular price. And even if Europe is possibly closer to equilibrium than some of the others, as more become eligible for index inclusion or ETF inclusion, they may then have this kind of runway to kind of replicate what the European market has done over the last couple of years. And even with Europe, you read a lot of sort of analyst forecasts and even sort of Bank of England, Bloomberg, UN, all targets are somewhere around the $100, $125, $150 mark. So even Europe potentially has a reasonable amount of upside there.
10x for California.
10x for California, exactly.
And I guess that makes sense because there would be a group of companies that at 88 euros can wear the cost, and so there's an incentive to keep ratcheting that up slowly and slowly and slowly to get more companies to feel that pinch, I guess. And that makes sense.
Yeah, you're right. Politically, they can't let it escape too much because things will just grind to a halt. But even on the 88 number, like I said, if you can't source enough credits this year and you then get penalized to the tune of 111, your opportunity cost, it's cheaper for you to go and pay 200 than to actually still have to buy the credit and pay the fine.
Oh, so the €111 fine is on top of having to go and source a credit?
Absolutely. So if you miss your targets for this year, and I think it's an April kind of calendar
the
year.
Europeans don't mess around, do they?
They don't. So, they not only say you still owe us the credits, but you pay the penalty as well.
It feels like there's I don't know who would have the money to do this. I don't know what the total market cap of European carbon credits is, but it feels like there's an opportunity for a BlackRock or someone to just corner the market and just sit them on their balance sheet and just make companies come hat in hand to them.
Look, like I said, I think, regulators hopefully will adjust supply and demand based on that. But, I think industry, those that, can see the risk of a higher carbon price on their own business, and it's obviously not necessarily on the investment side or asset management, but, like I said, they are buying these things and they are putting them on their balance sheets. So they could be cornering the market themselves.
True.
It doesn't need sort of outside, like I say, investment folk to be thinking like that. They may just say, look, we're going to need these things in future, and we're going to buy them whilst they're cheap because we kind of can see this supply deficit coming, or we can see the price going up for various reasons as well.
Is there a world where, because some of the world's major oil companies are in Europe, like Total in France and BP, and, do they just hop on a plane and move across to the States?
I mean, look, there's, again, the risk of sort of offshoring some of these emissions. But again, the talk within Europe, you're almost going to have tariffs, if you like, to say, okay, well, your supply chain is based, somewhere offshore. You're a really bad emitter. You're now importing these goods. Your carbon footprint on those goods is X. You're going to have to pay a tariff because you're importing emissions to Europe.
Yeah, that's the carbon border adjustment tax.
Absolutely.
Yeah.
So, it might work for a little while. Maybe you'll have these carbon havens somewhere around the world.
Well, it feels like Australia is that at the moment.
Yeah, exactly. So, I mean, look, people will try and get cute and work around it, but ultimately, the man on the street is demanding change. Politicians are being held to account. People, have legislation they need to meet, monetary penalties. You can't run forever.
Yeah.
It is fascinating. So, John, we are running out of time. So, just wanted to, I guess, close out with, you've mentioned that growing industry, as more and more markets mature, there's going to be more opportunity to invest in this asset class. From the mechanics of the ETF, as an investor, is this rebalanced? How do we get more markets into this ETF?
Yeah.
Is that the plan?
It is. Look, the index eligibility, like I said, is an ongoing review process. As and when markets, hit those criteria, they will become eligible. And, we obviously don't have sort of timelines on that, and the index provider's separate to us, but, I'm sure it will happen. In terms of the mechanics of the actual ETF, we just hold 1 year futures. And so we've been rolling forward to the December 23 contracts at the moment, because December's where the liquidity is for whatever reason. But I mean, the liquidity in these futures markets is huge. I think, Europe again traded about 650 billion euro last year alone. That's obviously much larger than some of the others. But again, I mean, they're a great little case study to sort of see, the design of the system, what could other, regions do. And again, just to sort of look at the UK, I mean, that almost replicates what's been done in Europe because they were part of that. So when they spin out, it's kind of, okay, well, let's take our learnings and recommendations and we set that up for the UK and off we go. So again, I think we'll see a lot more systems in place. We'll potentially see, voluntary turn to sort of mandatory as well. Where there's demand, there will be futures markets, and those markets will become eligible to the index and the ETF, and I'm sure we'll see some growth there.
Well, John, that does bring us to the end of the episode. The ETF ticker for those listening along that are interested in getting exposure to carbon credits is XCO2, listed on the ASX, Australia's first.
Absolutely.
Yes.
Yeah.
So check it out. A reminder, though, that we are not aware of your personal circumstances, and all of this information is for education and entertainment purposes. Any advice is general advice only. Certainly an asset class that is interesting, certainly playing a role in society. So thank you for educating us today, John, and all the best with the future prospects of XCO2.
Pleasure. Thanks very much for having me. It's been great.
Thanks, John.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.